William Jordan is back with us today from William Jordan and Associates, and we welcome you back to the show today.
Thanks, it's good to be here.
Let's talk a bit about something I think a lot of our residents would want to know, especially if they were going to sit down and talk with you about maybe helping them with their investments. And that's kind of your philosophy, kind of what helps you help them, so to speak. Some of the things that affect you, I guess obviously each individual is different.
Sure.
They come to you with X dollars, and you ask them some important questions, I think.
Yes. Well, I think the most important questions that we have to ask somebody are, first of all, what is it that they want their money to do for them? Oftentimes people come in and just want to know, well, what's the hot investment right now, or what should I be doing with my money? And that's really putting the cart before the horse. We can't answer that question until we know what they're trying to accomplish. Some folks in retirement want extra income right now. Others are trying to just accumulate for down the road. There might be a large individual purchase they want to make in the near future, or maybe they're not even retired yet and they're just trying to maximize the growth. So that's really the first step, is we have to have a sense of where we're headed before we can even begin to talk about investing.
Right, right. And I guess a lot of it depends on their kind of philosophical mindset, and you almost have to become Dr. Shrink and get into their head a little bit, because they're going to come to you with those certain goals in mind. And you're going to have to try and help them with all of that. So good conversation, good communication before dollars ever go anywhere, I guess, is important.
Yeah, that's a great observation. Because I've actually said to clients for the last 14 years, I wear the financial planning hat, but I also have to wear almost a psychology hat, because money is so emotional and it touches everything in our lives. Right. So it's how we feel about our investments even that's just as important as how our investments are doing, because those feelings can cause us to make investment decisions. Mm-hmm. And actually a big role of a financial advisor is helping people to step out of the emotions for a moment, or helping them to understand the emotions and then make good decisions.
Yeah.
Because often good decisions are doing the opposite of what your emotion is telling you to do at that moment.
Right. Recently you had an article in Life After 50.
Yes.
And it was dealing with the subject of trust deeds. Is that something your clients some have gotten interested in that?
Yeah, and it's only a recent, not a recent phenomenon, but it's only recently we've started talking to people about that again. From a real estate standpoint, I got out of real estate in 2005. Sent a letter to my clients, told everybody, if you've got real estate to sell in the next 5 to 7 years, sell it now, back in 2005. And everybody thought I was insane. I thought I might literally lose my business, because the real estate market kept going up another 8-9 months, and they said, William, if you can't read the real estate market, how can you manage my investments? And then what I expected to have happen happened, and then they thought I was a genius, and the truth's more in between.
Yeah.
But I always have said you could add real estate back into your portfolio when the income you can generate from it would be at least 10%. And so last year we started seeing those opportunities where people could get 10% in shorter term trust deeds or other types of real estate investments with an arguably very low level of risk.
And I understand you have people in your office, in your staff, that are actually real estate experts that can really even give specifics in that area as well.
Yeah, with a focus as a wealth team, I can't be an expert in every nuance of every single area of investing, so we do have other people that we can bring in. So we have real estate experts both on the lending side as well as the acquisition side, and then my expertise is more in the risk assessment side to really look at, in this case, trust deeds and identify, is this something we should be investing in or not?
Right. When you talk about risk, a lot of people, especially as we get older, think, boy, I want to minimize my risk. So rather than maybe buy stocks or gold or property or whatever, I'm going to get into bonds, because bonds are a safe way to go. And the sort of the traditional, conventional wisdom has been, when you're younger, you have lots of stocks and maybe a little bit of bonds. And as you get older and closer to retirement, the stocks go down, the bonds go up.
Right.
By the time you're fully retired or in maybe your 70s or 80s, you're almost all in bonds.
Yeah.
You get that constant income stream, and you have maybe a bond fund.
Yeah.
And again, that's traditional thinking. You're saying that sometimes for those of us over 55, that may not be the right way to go.
Well, and I think the danger with bonds right now is looking in the rearview mirror to make our decisions. As you talked about, the stock mix generally lowers as you get older because we don't want that level of risk. The question we have to then ask is, what's the level of risk in bonds right now? And bonds are fairly easy to understand in that they work kind of like a teeter-totter with interest rates on one side and bond prices on the other. So when interest rates are high, bond prices are very low, and when interest rates are low, bond prices are very high. Bond prices are very high right now, so if I were to put my finger on the next bubble, it's bond prices. So that creates a concern for people who are using bonds for safety in their portfolio. In most cases, they're not familiar with the level of risk. And the good news about bonds is you can argue a specific maturity date so you know what your yield to maturity is. Although I just looked at a client portfolio, or a potential client portfolio last week, they had several bonds where their yield to maturity was negative. The interest that it's going to generate between now and the time it comes due is not equal to the price that's going to go down between now and when it comes due. But in most cases, it's not that bad. The biggest concern for bonds would be in the area of bond funds, as you mentioned, because a bond fund does not have that maturity date. And so it's indefinite that you're holding. Yeah, and that creates a whole host of challenges. Well, unless you sell the fund, but when is the right time to sell an investment? When it's up?
Take the loss,
yeah, most people are going to say, well, I want to sell it when it's high, but yet then when it falls, that may be the right time to sell. And the real concern is not that we could have one bad year with bonds or bond funds. If you go back to the late 40s, early 50s, which is the last time we had interest rates in this environment, the next 4 decades, we saw real returns negative with bonds, with fixed income, meaning every year we lost money for 40 years as it related to inflation.
All right. For those of you with lots of bonds, listen up, I guess, is the message there.
Yeah.
Stocks are also a good portion of people's portfolios as well. And I know you're not one of those who says you should look at the stock market running, little ticker running at the bottom on the business channels and buy and sell, buy and sell, buy and sell. You take like a 15-year approach to that.
Yeah, I think what's most critical about stocks is understanding what's the role they play in your investments. And if you have to look at today's stock market ticker to know how you're doing and if you can go out to dinner tonight or not, then you have the wrong plan or you have the wrong allocation, because stocks are a long-term investment. And historically, people have talked about, make sure you're in stocks for at least 5 years, things of that nature. But if you go back historically and you look at 15-year periods of time, a 15-year cycle, you'll never find a 15-year cycle, including the Great Depression, where people lost money in stocks. But you will find 5-year cycles. You can find periods like the last 10 years that we've just seen where people have lost money just buying and holding stocks for a decade. And that's a period you'd normally think of as safe. And if you're trying to take income out of those stocks during that time, it's a problem. So what we'll do with our clients' stock portfolios, we really put that into our 15-year bucket, where essentially I can tell the client, this is money we're not going to spend in the next 15 years. We'll spend it years 15 to 20. But that means we better have other safe investments that can throw off the income we need for the next 5, 10, 15 years.
It's interesting when people do go on and look at their, whether it's online or some other way, a lot of times you can click on that stock and it'll show you a chart.
Yes.
And you'll see, oh, it's up today or down today. And then sometimes that'll be just today. And then there's maybe an option you can click it for 6 months.
Right.
And maybe one that you can click it for a year and you can see the graph go up and down. And then, but sometimes you can go a big 5 years.
Right.
And that may give you, again, a false reading, because when you're thinking more the 15-year look at these things is more appropriate. A lot of those charts don't go back that far.
Yeah, well, it goes back to what you brought up earlier, almost the psychology of investing. If you're in the stock market and you feel like you've got to make a decision as to, can I afford to stay in? If the market starts heading down, boy, I'm going to need to get out, then you probably shouldn't be in stock market, because now you're really speculating in the stock market, not investing. And that's okay if it's your play money.
Right.
But if it's your serious money, you have to have it prioritized correctly. And so that's why I do a lot of talking on maximum income and how to maximize income in retirement. And one of the keys is make sure you hold your stocks in the right bucket where you don't need to pull income from that.
Yeah. A subject that we don't have time for is annuities, and maybe we can get into that in a future program. Some people love them, some people hate them. And
I both love them and hate them.
And you have some thoughts on that and some alternatives as well. So see you back here in a few weeks.
I'll look forward to it.
Thanks for joining us. Good to have you on the program today. Again, that's William Jordan and Associates. And again, you can find out more by contacting their office just nearby and get some help from them with your investments.